Good morning and welcome to the Saxo Bank Morning Call. It is Friday, October 26th, and we have a lot to get through today, especially on the equity market. Yesterday in Wall Street, the New York session trying to put a brave face on things going into the close. Saw a bounce, but then after the close, Peter, a couple of the biggest of the big companies reporting some earnings, and especially as a top line that seemed to be the focus with this Amazon and Alphabet results.
Exactly, and the top line is where you really get hurt the most. We had declines of 7% in Amazon, and we had 4% decline after the close in Alphabet, the parent company of Google. So there's a lot of action going on, and if we cannot have strength among the technology segment, then I don't know where we go from here in equities, and it can be very tough.
These are the momentum superstars.
Momentum superstars, the bellwethers, the big index weights, and they have always had very robust earnings growth there.
You've got some charts here. Free cash flow seems to be the focus, and the international results.
Yeah, so exactly. So I'm trying to come up with some clues to why we saw that rather big drop, actually. And as you can see here from the Q4 numbers, the guidance for this current quarter is quite disappointing against expectation. And then also the international sales. That's what I've marked here with the orange rectangle. If you look at that, you can only see 13% year-on-year growth. That's very low. It's actually quite disappointing for a business that is growing close to 25, 27% in North America, and very more high growth rates in cloud. So I think they have trouble in the international. As you can also see on the operating income to the right, it's still negative. So I think they have more competition. It's more difficult for them to grow international, and that would be a big disappointment for them. But the free cash flow generation is still good. It's up, but the guidance is weak. So I think this could be a turn, actually.
And then on Alphabet, we saw this difficulty on the top line, and apparently some weakness in the ad results.
Exactly. So they showed a slight miss. I would call it in line, but it was a slight miss. And I think most importantly, their revenue growth on their own, what they call their own properties, because they have a lot of these third-party partners where they get traffic from. And you can see the quarter. You can see from quarter to quarter the year-on-year growth rate is already coming down. So maybe not a big surprise, but a 4% in only one quarter is a big thing, because that means that already next year we'll get much closer to maybe only 10% growth. And then it changes the whole valuation dynamics of Google. And we know there's a lot of headwind coming into Google from the EU. There's more fines coming, and they are under pressure. So, and then there's the whole CAPEX. They are using a lot of CAPEX, investing in all sorts of different businesses. That has been a big question mark for a long time. So we definitely see weakness in technology.
Interesting, but not Intel, but we won't get into that. But Intel posting strong results.
I will comment on Intel on Twitter and home.sax.
Okay, great. And as a technician, if you look at the chart here, I've got the S&P 500 future. The 200-day moving average, I put it in here for perspective. It's not very accurate because this is the future. It's a few points off, but we're slipping pretty far away from that. I would argue that this low for the cycle that was posted on the initial decline towards 27.12, 27.10, whatever you want to call it, they tried to take back yesterday is the local sort of tactical focus on whether we hold the line. And as Peter and I discussed in technical terms here, we're near that 10% correction level. We've sort of touched that area at the lows here below 2,700, that 10% correction. Then you start talking, if we're beyond the correction, the bear market territory, which is a 20% decline. The other big news overnight, very big news, very small move, but very big news because it happened, the dollar CNY rate touching new highs for the cycle. And Ole, gold has been obsessed with the idea that maybe these bond and equity correlations are going positive. We're seeing a little bit of a safe haven bid in bonds, and I think, and then with the UN weakness, gold is just doing nothing. It's gotten tired.
No, that's true, but I think it's more or less been, to a certain extent, been doing what it's been doing in the past this week. We've seen, as John mentioned, bonds has moved higher. We've seen the rout in stock markets. Gold has managed to hold on to this 12.30, 40 area, and really it's happening at a time where dollar has actually been quite strong this week. We've seen a general dollar strength across the board, and despite of this, gold has managed to hold on. So it seems like we have an underlying bid. It seems to be safe haven driven. But obviously with the yuan, big question, what happens if we break above 7? Right. Will we see that link start to be reestablished and gold suffer once again? So
and the sensitivity there on the yuan as well, not just in precious metals and otherwise with the dollar, but also on the Aussie. Aussie dollar been very quiet through all of this equity market volatility. It tends to be one of those currencies that's more susceptible to risk on, risk off type of behavior, but it seems to be the eye is on the dollar CNY there. I've got a chart here showing how suddenly we're kicking into gear and seeing new lows in Aussie dollar, even on this very, very slight, in percentage terms, very slight new low for the cycle in the Chinese currency. And I think, of course, if we see that $7 or that 7 to the dollar level in dollar CNY slipping, we're going to see a lot of expansion and volatility. To me, the volatility looks underappreciating. If you look in the options market, implied volatility is looking far too cheap for the Aussie, given the risks of a larger move here. And then we've been talking Treasuries here. I've got a chart on the U.S. 10-year. I think it's really key to track this. To what degree are Treasuries going to serve as a risk, as a safe haven if risk-off continues? We're seeing a little bit of safety seeking here. When with all the equity bleeding, you would expect more, of course, relative to historical patterns. But this 3.1%, arguably 3.12% level, is the beginning of showing a breakdown again in yields. Bonds are getting bid. I would say if we're back below 3%, something has really happened here in terms of changing the direction.
Exactly, what you just touched upon, that we would have expected a bigger move. I saw an analysis yesterday that showed that in a 10% correction move, if you just use the past 2 years data, you should be trading much closer to 2.4, 2.5% in the 10 years. So definitely there's a divergence, and I think is quite interesting because it tells you that something is going on in the fixed income market.
Exactly, the safe haven seeking is there, but it's very, very weak and very dampened relative to historical patterns. And we're even seeing, I've got a little, not very pretty graph here, but a chart showing the Eurodollar 3-month futures. We're actually starting to see some bits of inversion out there in 2020. The prices, you notice, say from the present or the next contracts dropping, and then around mid-2020 they're going back up again, suggesting the market is beginning to think that the Fed makes a mistake and has to reverse course over that time frame. So that's an interesting development there. And as well in FX, finally on noting what's going on in FX relative to these fixed income moves. Dollar yen, I think the potential is there. We have to see a significant bid coming into the U.S. Treasury market, much lower yields, but dollar yen getting at some pivotal levels down here below 112. You can see the big trend line, the prior sort of high, the Ichimoku cloud, the local low. It's all sort of swarming in there in the 111 to 112 area. And again, yen volatility I think could also pick up on any move in the Chinese currency. Now on commodities, you have an overview here of the relative moves across commodity space. We're seeing a lot of weakness that's getting linked to perhaps fears that the global growth is coming off.
Absolutely. As you can see there, when you have a week where we've got a combination of stock market rout, you got a stronger dollar, and you got as you see, the dollar there is up relatively strong this week. Then all sectors are suffering, with the exception of precious metals. So this is a typical risk-off week for commodities. The energy market has been hurt by the growth, lower growth leading to lower demand, but also the fact that Saudi Arabia is now saying they're going to supply all the barrels that's going to be needed. So yes, it's just highlighting that this worries that are also now spreading to commodities.
There was an interesting note. I don't know the import of this, but there was a note I saw crossing my screen that China has asked 2 of its big oil companies not to purchase any more crude from Iran. Didn't seem to get much of a reaction in the crude market.
No, because the theme right now has really changed back towards the lower demand narrative. But I think with the sanctions against Iran from U.S. Only kicks in here on November 5th. So really, I think we have to be cautious about getting too negative on oil because, yes, the macroeconomic outlook doesn't look too bright, but inside the oil market, the fundamentals there looks reasonably supportive. So I think we should be cautious about getting too negative at this point.
Okay, and on wheat, though, you've got a pretty ugly chart here where it looks like we're trading at lows all the way back to around February last year.
That's true. It's what we're seeing there is just this immense volatility we had in wheat this summer. Big spike followed by a big drop, and now the bottom seems to be falling out of it. The reason why we're dropping right now is the fact that there's been some concerns about Russian production this year, but still they're just exporting at full speed. And with the same time, when we got the dollar strength as we have, the U.S. farmers are struggling to compete. So we need to find a base. We need to find a price low enough for U.S. exporters EU exports to pick up.
But it's also interesting to see with the whole agricultural space. It's so weak, right? Because we're talking about inflation all the time. We have the push from energy, but we're definitely not getting the push
from food. No.
Exactly. So, and you had Draghi on the press conference yesterday talking about inflation. They were confident that it would bounce come back up towards the year end. But if you don't have any pressure on the agricultures, then it's going to be difficult, I think.
Just want to mention
they're talking their intentions, I think.
Yeah. Just want to mention on the chart once again, if we can see it, that there are some reports out today. We have reached a level where we are starting to be competitive with the Russian wheat exports. Today there's a weekly tender from the Egyptians. They are the world's biggest buyer of wheat, and if that goes in favor of the US, that could potentially be a turning point for the market. So that's key to look out for today.
Okay. That takes us to the macro calendar for today and for next week, which is getting pretty busy if you look at all the blue and red for next week's stuff. Russian central bank out today. To me, the ruble looks awfully strong given oil prices and given a rather wobbly risk appetite, to say the least. We have the first Q3 GDP estimate out of the U.S., 3.3% apparently the consensus there. I don't know why the market focuses much on what is essentially ancient history by the time it rolls around, and something that gets heavily revised, but it does elicit market reactions. As well, just a reminder in general, we've talked about this recently, this is a Friday. If we close in a very, very ugly situation here on a Friday, just historically it's not good when we're seeing a major sell-off to close on a low note for the week. It makes for nervousness the following week. Just to suggest that we should have our horns out for the risk potential there. And then back to the calendar. Over the weekend, we have this German political situation really picking up with the Hesse state election. There are risks to the coalition. There are risks of an unprecedented early snap election in Germany if the results for the SPD and the CDU are particularly weak there. It's looking like they will be weak, but will this result in a new election? On the one hand, the SPD desperately needs to extract itself from this coalition. On the other hand, if they call elections now, it's just going to cement their weakness in a new national election. So I don't see how they call elections right away. Nonetheless, it could affect Merkel's status going into that December party conference of the CDU, CSU. And that, of course, brings new, I think, longer-term EU existential risks. And then next week, you have the PCE inflation up on Monday. The Eurozone CPI estimate, all the ISMs around the world, manufacturing and not non-manufacturing, which is the following week, early Monday, and then, of course, the U.S. earnings in focus, and especially because the print there for those October earnings expected to be at 3.1%. It would be a new cycle high. It could even be a wild upshot to the upside, depending on the randomness of this crazy average hourly, or sort of average weekly hours, which, a 0.1 hour random difference or swing there could actually see it suddenly spiking to new highs and generating new concerns that inflation is going to see a stronger reaction from that.
And then U.S. midterm election just 2 weeks away. What a mess.
It is a mess. We have bombs being mailed to various people and caravans heading towards the border and a general circus atmosphere. The predictions are, at least by the likes of Nate Silver and his statistical look at polls, etc., is that the Democrats appear to have a lock on the House of Representatives, and the Republicans will retain the Senate. But we were quite wrong the other way around in 2016, and it does appear that many doubt that this so-called blue wave will happen in the U.S. We'll talk a lot more about that. It's another 6 to 7 trading days away. For now, be very careful out there, and let's see how we close this Friday heading into a weekend, and we'll be back next week with the Saxo Bank Morning Call.